Success with Options. Today I wanted to do a video presentation that's a little bit different than some of the ones that I've done. I want to talk a little bit about premium selling as a strategy. Now, if you've been to my website, looked at some of my Trade of the Week pages, or looked at my strategy pages, pretty much all I talk about are premium selling strategies. And so I wanted to take a little bit of time today and talk about some of the reasons why I prefer to sell premium as opposed to buying it. So why sell premium? Well, one reason is that options are more likely to expire worthless. It's definitely more likely that the option is either going to expire completely worthless or worth less than it was purchased for, just by the nature of market movements and the fact that when you buy an option, you're basically buying a wasting asset. So you have time ticking against you. And so that's another one of the features that I like. Another feature is that trades are more fault tolerant. What that means is that I'm less dependent on the underlying asset, the stock or ETF or whatever I'm trading options on. I'm less dependent on that thing actually going in the anticipated direction. There's much more tolerance. And we're going to talk about this a little more in future slides. And as I mentioned earlier, time is on my side. If I'm a seller of premium, then I'm basically selling a wasting asset to somebody, knowing that as time goes by, that thing is becoming less and less valuable, which means if I sell it high, I can buy it back low. That's basically the premise behind any of the option selling or premium selling strategies. So let's jump in and take a look at a couple of examples. I typically trade variations of about 3 different strategies: the vertical spread, the iron condor spread, and the calendar spread. So what I want to do is jump into some examples and show you why selling premium can be more advantageous. First of all, let's take a look at this chart. EWZ is a ETF that I've traded a number of times. I've actually sold vertical spreads pretty much all the way up this move up. I've made money on this trade. And here what I wanted to point out is that we have potentially a sale of a vertical spread where the short strike is set at $62 as indicated by the red line over here on the right. Now we're looking at the hard right edge and we really don't know which way that thing could move. Now when you think about market movement, typically you think about it moving in terms of possibly going up, possibly going down, or possibly just going nowhere at all. It just kind of stays in the same trading range, doesn't go up, doesn't go down. But in reality, there's 2 other directions I think we have to consider. One is it may go up only a little bit, or it may go down a little bit. Now we're looking at 5 possible directions that this ETF could move. How many of those would be allowed to occur and this trade still make money? Well, it could go up a lot, it could go up a little, it could go nowhere, or it could even go down a little bit, and I have enough tolerance in this trade that I can still make money on it. I may not make the full credit, but I would probably make a large percentage of it. And the only direction that would cause me to actually lose money on this trade is if the market went down a whole lot. So that's why I love to sell vertical spreads. Vertical spreads are probably one of my favorite option trading strategies, and I sell them over and over again, whether the market's going up, down, or absolutely nowhere. Here we have an example of an iron condor trade. Now let's step back in time a little bit and revisit a period of time when I might have been tempted to put on an iron condor that was somewhat equidistant from the current price, which is trading right about here, 104. So I might sell a 109 short call strike and a 100 short put strike and have an iron condor. Now in this particular position, going forward, we're trading off the hard right edge, which means we have no real good idea what direction this trade is going to make. So what I want to show is that how some potential movement in this particular stock can still cause an iron condor to make money, even though we experience a number of times when the stock goes against us. So as we look forward in time, we've moved forward almost a week in time. We're beginning to see our 109 strike being threatened on the call side, while our put spread has become virtually worthless. In fact, as time goes on, we may find that we can actually close that position out completely and we're left with a short call vertical spread, which is a bearish position. Now at this point we really don't know what's going to happen. We may look at this position and we may see a situation where the the SPY continues to move up through 109 and just rockets up and creates a whole new leg up as we've seen in the past, or we may see this thing form a double top and the thing begin to actually crater a little bit and move down towards the lower side of the range that it's been trading in. Well, what happens when that particular event takes place? Now we can close the call side. So that's obviously an idealistic perspective, but the truth is that I've traded the iron condor spread a number of times and had that exact same thing happen to me. So as time goes on, we may see the stock make its usual movements. It vacillates, it goes up, it goes down, it ebbs and flows. And that ebb and flow actually allows us to be able to manage our trades. If we're doing it fairly actively, we can close a position on both sides, even though we've had the stock go against us in both directions. Now let's turn to the calendar spread example, and let's use the SPY as our example again. But in this case, instead of selling an iron condor, let's say that we chose to buy a calendar spread on the same date, and we're making an assumption that from this point on, that at some point in the future we're going to see a pullback, possibly all the way down to 102. So I'm going to choose to purchase a calendar spread. In this case, just for an example, let's say that I chose to sell the short November 102 and buy the long December 102. So we've got a 1 month calendar spread, just to keep it simple with no rolls or anything like that. What I want to illustrate is, again, the possible movement that would allow us to make money on this particular trade. So we've already seen what's going to happen with this going into the future. This thing moves up, but just because we've seen it move this far against us does not mean that we've lost a ton of money in this position. Why is that? Well, the reason is because the front month, the November short 102 that I've sold, is losing value faster than the December 102 that I purchased. So what that means is that I'm still holding on to a significant amount of value on this calendar spread. And as we go forward into the next couple of weeks, what might happen if this stock begins to crater and come back down into the range? It could move down to 104, 103, and we might still see a significant increase in value. So there's a large amount of tolerance that we can experience in these kinds of trades, and that's what I really wanted to illustrate, is that the trades that I choose are put on for a number of reasons that I'm going to talk about here in a minute. So that's why when I trade options, my option trading strategy is really made up of three key things: defined risk, positive time decay, and managed delta. And this is not an invention of my own. In fact, many of these ideas have come from the folks at Thinkorswim and their excellent training that they offer for free, by the way, in their Option Planet classes. Many of the larger cities they visit at least once, if not twice a year, or even once a quarter, and they teach a lot of these kinds of strategies. And if you get a chance to attend those, I'd encourage you to do so. In the meantime, there's a lot of information on the website, www.successwithoptions.com, where I talk a lot about defined risk trades, positive time decay, and managed delta. These are kind of my trading guidelines. This is how I trade. This is how I continue to make money in this market, even though it's choppy. It's up, it's down, no matter what. So I want to thank you for visiting this video, and as always, I talk a lot about the strategies themselves, but behind the strategy is always an options trading system that I talk about, which includes money management. It includes a trading plan with rules for getting in and getting out of a trade, and I'd really encourage you, before you begin trading, to start thinking about what your option trading system is going to look like and what are the mechanisms that you're going to use to track your success, including a trade journal and trade log and so forth. So for all of this and a lot more, please visit www.successwithoptions.com. Thanks and happy trading.